Hello and welcome to the first video to go over the material for Principles of Accounting 1. My name is Dave Karn and I'll be your instructor for this semester or session. And what we want to do here with our first video is kind of go over some basic things to kind of get us ready to start going through the accounting cycle and building that. So let's jump right into the material here and go through some stuff together. Okay, the first thing that we want to do is we want to look at the forms of business ownership. Now, there are primarily three of those that we will just talk about here: sole proprietorship, partnership, and corporation. And what we want to remember here is for this particular course in Accounting 1, just know that we will be covering sole proprietorships this semester only. But we certainly should know the characteristics about all three. So let's look at sole proprietorship first. Obviously, it's a one-owner business, and you really have the ability to make decisions as the owner. You are your own boss, okay? And of course, you'll probably wear many hats and have to balance many different things as you're running your own business. Okay. Now, the one thing that's nice about being your own boss is that you don't have to share any profits. But if you have a loss, you must bear all of those on your own. Your tax on your personal income, and really, if you think about it, you are really limited to your skill set as far as what you're doing in the business, meaning you may have to outsource some things. Let's say you're really good at marketing or sales. Well, you may not be good at payroll or accounting, so you might want to outsource those functions. That's perfectly fine. So remember, you've got to think about what your strengths are and kind of go with those, and then ask for help from other folks as you see fit. One thing that's important to remember here is that in most cases, a sole proprietorship, you as an owner have unlimited liability. That means that you would bear all the losses, and if you don't have enough to cover losses, let's say you default on a loan that you owe a creditor, you would actually have your personal assets like your house, your car, other things and other investments you may own personally at risk, meaning that the bank that has your loan could actually come and try to take those assets from you on a personal basis. So you want to be very cautious there. Okay, moving to a partnership. Obviously, you would have at least two owners in a partnership. Again, your tax on your personal income. And again, you have unlimited liability, meaning that they can again come take your house and your car or other assets from you on a personal basis if you are not able to pay your debts accordingly. The one thing that's a little bit scary about partnerships is you really need to trust the people that you are in business with to the highest level that you can because of mutual agency. Mutual agency means that I can act, let's say I'm in a partnership with my brother, I could act and make business decisions on behalf of the partnership without his knowledge, and he has that right as well. So if there would be a case where I made a decision that he wasn't happy with, that decision would still be enforced because I have the power of mutual agency. So you've got to make sure you're really, really trustworthy with the people that you go into business with in a partnership setting. Obviously, the nice advantages to this, if you have more people that are in the business as partners, you have more talent. You could spread the talent around the different strong areas of each person. So the skill set of each person could be, really a nice way to balance out the duties. Some people are silent partners. Some people may be good at sales and marketing. Another partner may be good at accounting and bookkeeping. So you may be able to cover more of the things that way than you could in a sole proprietorship. Make sure anytime you go into business in a partnership setting, you want to get the partnership agreement in writing. Just remember that if there is no written agreement, profits and losses are shared evenly among the partners. So if there were two partners, it would be 50-50. If there were 10 partners, it'd be 1/10 per person. Okay, moving on to a corporation. There are many owners in a corporation. In fact, those are called either shareholders or stockholders. Very simple to raise capital, meaning that you can actually sell stock in order to get funds to help run the organization. In the eyes of the government, a corporation is an artificial being. And remember that you really have quite a few folks that are going to be kind of running this. The board of directors is going to be elected by the shareholders, and then they're going to impart their vision of how the company should be run onto the management. And really there's lots of talent there. So as far as you're going to have a lot of people with lots of different skill sets to help run the organization. There are a couple pitfalls when you think of really a corporation, and that is double taxation, meaning that because the corporation is an artificial being in the eyes of the government, it itself will be taxed on the earnings that it makes. And then if the corporation issues dividends to its shareholders, meaning they're going to share their profits and losses, really their profits with their shareholders, a shareholder will be taxed on those dividends as well. So there would be the earnings are going to be taxed twice in that circumstance. The nice thing about a stockholder is you have limited liability as an owner of a corporation. If you invest $1,000 in General Electric stock, the most you could lose would be $1,000. So you're not going to be at risk of any personal assets being taken from you if the company would not succeed. Okay, let's define accounting here. Really the definition of accounting is pretty straightforward. Basically, your accounting is defined as something that measures, processes, and communicates financial information about a business entity. And so really what we talk about here is accounting is really called the language of business. We need to start at the very, very top, as far as the very beginning, where the business opens its doors, and we have to be able to, from that first day, have a system in place that will measure all of the transactions, process them, and then communicate to any owner, any creditor, any person that's really allowed to see the information, what the financial position of the company is. Did we generate a profit this particular period? Or did we incur a loss? What really does the owner have a right to as far as the assets of the business? So how much do we owe to other people? It could be vendors or creditors. So lots of things going on here that we are going to want to know. And really the payoff for us is, as we build the accounting cycle during these first 4 chapters, how do we stand financially? What is the true financial position of the company? And we will get there by being able to produce financial statements of the company that we're looking at. So who are going to be the ones to use accounting information? So I have a little list here of internal versus external users. So if we look at these, obviously internal users, you're going to look at managers, employees, owners, internal accountants. Those would be folks that would be interested in knowing the kind of what's going on with the accounting information inside the company. And then there's going to be quite a few folks externally that may be able to look at this information and want to know what it is. Obviously, any potential investors or stockholders are going to want to look at this if they either are thinking of investing or already invested in the company. Your IRS or other governmental agencies are certainly going to want to know this information. Your certified public accountant would want that information. Obviously, your creditors and lenders, the folks that you owe money to, are going to want to see this information. And in some cases, community members may have a right to see it. Now, obviously, if you are a sole proprietor, privately owned company, a one-owner business, you do not have to share your information with anyone that just walks in off the street. That is your personal, private information. However, if you have a loan with a bank, obviously they would have a right to see the information because you owe them some money in consideration for a loan that you receive. So obviously in some cases you've got to give the information to the appropriate individuals. Now anyone, if you think of a stock situation, any publicly traded company on the stock exchange must file what's called an annual report. And what you want to realize there is that anyone can request that information from a publicly traded company at any time. So it is really available to anyone that wants that information for any reason whatsoever. Okay, there's a couple governing organizations you should familiarize yourself with, and you want to probably take a look in their text about this. I'll just go over a couple of those here, and then obviously we also will talk briefly about GAAP. The FASB is the Financial Accounting Standards Board, and they're responsible for creating the accounting policies and procedures to help us create this language of business. And believe me, some of those policies are very complex, but for now we're just going to be doing very simple basic accounting / bookkeeping here. The SEC is the Securities and Exchange Commission. They govern the stock market. And what you have to remember here is that they oversee the stock exchange, and they follow up to make sure that the companies are providing the annual reports to each year to the appropriate individuals. They must file this and make it available each year. And finally, GAAP is referred to as Generally Accepted Accounting Principles, and that is what we will follow this semester going forward. And we really make sure that we can't violate these rules. Okay, a couple principles and assumptions that we have to make as we go through this beginning part of the course here. The first one is the economic entity assumption. And this is pretty straightforward. Let's say that I have a business. Let's say I'm a DJ, and I have a DJ and kind of music business, and I start this business. I must, with no doubt, have separate bank accounts for my business from my personal bank accounts. The reason being is, let's say that I took a potential client out to dinner, and I went to, let's say, a restaurant, and I charged that on my personal bank card, and then 2 days later I took my family out to the same restaurant. If I didn't have separate bank accounts and check cards or debit cards, I would be confused at what was a business expense and what was a personal expense. So you definitely have to have your business affairs separate from your personal affairs. If we look at cost principle, that's very basic and pretty easy to understand, and that is, it's also referred to as his historical cost principle. So whatever we pay, whatever the cost is what we record for the transaction, and that's referred to as our cost basis. Going concern, this basically states that unless we're told otherwise, the business is going to continue operations for the foreseeable future. Now, obviously, if someone said that, came right out and said that they're going to be shutting down operations, that would be to alarm us that they would be closing. If someone says they're filing bankruptcy, that may be a red flag. But in some cases, a bankruptcy may actually just be a temporary situation so that they can reorganize themselves and they still won't be closing down. So just kind of keep that in mind. And finally, for the monetary unit assumption, obviously for the U.S. we'll be using the U.S. dollar, and remember that the U.S. dollar is subject to inflation. Okay, if we look at the three primary financial statements, and again, three that we're looking at this semester and a fourth one for accounting 2, you look at the income statement. We'll measure revenues and expenses there. The statement of owner's equity, that will tell us what the current balance of the owner's capital account is. The balance sheet will tell us the financial position of the company. And the statement of cash flows, we really won't get to that this semester, but that measures exactly where our cash is going into 3 different activities, specifically operating activities, investing activities, and financing activities. Okay, so now we get to start to build the accounting cycle. And the accounting cycle really is going to be a 4-chapter process that we're going to take on here, really for the first half of the course. And we'll get through a couple steps here today with this video. And so let's look at the very first step. The first step is to analyze source documents to determine if a transaction has occurred. Now let's talk about the source documents. There could be many different things that we could look at. There could be receipts, invoices, time cards, payroll registers. We could have shipping forms. We could have really any type of document that we could look at to see if a transaction has occurred. Doesn't mean that it has. So if we have determined a transaction has occurred, we would go to step number 2 of the cycle. And if we determine that a transaction has not occurred, we will stop and do nothing. We will not have to do anything going forward. So once we've determined a transaction has occurred, we are going to look at step 2, and that is to record all transactions in the general journal. Okay, so to do that, we need a little bit more background on really the accounting equation and our rules for debits and credits. So let's proceed to that area. Okay, the accounting equation, which you really kind of need to memorize here and really know very, very well. The sooner that you can know these, the accounting equation plus all of the rules associated with debits and credits, the quicker that you will be able to get this material down. So let's look at the definitions of each of these categories. Our accounting equation is assets equals liabilities plus owner's equity. So let's define them. Asset is really something we acquire that will hopefully have a future economic benefit. And what we have to remember here is that if we go out and buy a delivery van for our florist business, let's say we paid $10,000 for that. Well, let's say 2 weeks after we bought it, we've hardly used it, and the engine blows up in the delivery truck. Well, guess what? While that was an asset, delivery truck, it really didn't provide us any economic benefit if we already have to just kind of get rid of it because it's really not useful to us anymore. So just because we may acquire an asset doesn't mean that it will be something that will have a future economic benefit for us. When we think of liability, we think of something that we owe. And remember, it may not just be money. Okay, we may owe, in some cases, either goods or services. So let me explain a little bit further there. Let's say that we own a photography company. If we own a photography company, we may ask for someone to put a deposit down in advance of their session. Well, if they give us money in advance, we haven't done anything to earn that money yet. So that would mean that we would owe services to them, and we would not be able to really record that as earned revenue until we provide those services. So just keep in mind that a liability doesn't have to just mean that we owe money to somebody. Then we get to owner's equity, and that simply is the owner's stake or claim to the assets of the business after the liabilities have been paid. So let's think about this. If I have cash in the bank, let's say $100,000, that's the only asset I have. I owe $20,000. Well, my owner's equity would be $80,000 in the business. So we will see the owner's equity, the primary owner's equity account is called the capital account. And we'll see how that works on the next several slides when we look at the chart of accounts that we're going to take a look at. Okay, there are 4 things that impact owner's equity. They are withdrawals, investments, revenues, and expenses. And you can remember that by wire. So obviously a withdrawal, if an owner withdraws something from the business, it's going to cause owner's equity to decrease. If they invest something in the business, it's going to cause owner's equity to increase. If we have revenues, that's a good thing. We're generating revenue. That's going to cause it to increase. And obviously we are going to have expenses along the way, and that's going to end up causing owner's equity to decrease. Now, one thing that you can kind of help remember the accounting equation by, and I wrote in the top corner of the slide here, is ALLO. So assets equals liabilities and owner's equity. So maybe that will jog your memory as far as remembering the accounting equation. Okay, let's look at our rules for debits and credits here. Now, the T account is very, very simple teaching tool to help you learn the basics here in the beginning of the course. So a T account is set up like this, and that is, it's going to have always debit on the left side of it and always credit on the right, and the account name will go on the very top of the line. Now, let's pause here. Please note that if you understand banking debits and credits, that you want to kind of erase that from your memory bank here. Our debits and credits are going to be very different, and you just don't want to think of the banking debits and credits as the same debits and credits in the course. So how are we going to remember our debits and credits? And we got a couple things here to help us jog our memory. First is AWE, or all. You will be in all of the accounts that have debit balances. And those accounts that have debit balances are any asset, the withdrawals account, and any expense account. So the way that we set this up is, if you debit any of these accounts, they will increase, and the balance always has to be on the debit side. And if you credit those accounts, they will cause them to decrease. Now let's just make sure you understand here. They are not going to want to trick you right now. So we are not going to have any circumstance where an asset account, obviously cash is an asset account. In theory, you could overdraw your cash account, but we're not going to trick you now. So under no circumstance will any of these accounts have a balance that ends up on the credit side. Now, one thing I'll also add here is I wish that I had a theory or rationale to share with you on why this was this way. The rules for debits and credits are just because. There's no rational explanation. Debit's always on the left, credit's always on the right. You can debit or credit any account. You just have to make sure that you follow the rules. Any asset, withdrawal, expense always will have a debit balance, and any the capital account, any liability account, or any revenue account will have a credit balance at all times. So if you look at this, you can see that I have a little thing to jog your memory here. The cleaner calcium lime rust. Make sure you know that stands for capital, liabilities, revenues. And obviously you can see that credit increases those accounts, so the balance must always be there. And then if you debit those accounts, they will decrease. So again, you're never going to have the capital account, any liability account, or any revenue account have a debit balance at the end of the day. They're not going to trick you doing that. It must always follow the rules. Here's a list of common accounts that I said we were going to take a look at a minute ago. You can see that assets, let's look through those. Obviously, cash is an asset. Accounts receivable, that is the amount owed to us by our customers, meaning that we gave them credit, so they owe us money for services that we provided to them. You also may have loaned money to a person. That could be then they signed a note, so you would probably not only be owed the money that they borrowed from you, but you would also be charging them interest and generating interest revenue from a note receivable. Obviously, office supplies would be an asset, furniture that we buy, building, and land. Liabilities, accounts payable, that's the amount that we owe to other people, such as our vendors or banks. And you can pretty much have any payable you may encounter. You could owe salaries, you could owe interest. You could sign a notes payable, meaning maybe you borrowed $200,000 to help buy a building. Well, you not only have to pay the amount back, the $200,000 back, but you'd also be incurring and have to pay interest expense on that note. When I referred to the photography business earlier, and they prepaid an amount to us as a deposit, the money that we took in is actually referred to as unearned revenue, and that's a liability. Again, that's a situation where we either owe goods or services to our customers that were paid for in advance. We know that the primary owner's equity account is the owner's capital, and you would want to put the person's name, comma, capital there. If the owner makes a withdrawal, that would be recorded in the withdrawals account, and you would have the same thing. You would have the owner's name, comma, withdrawals. Our primary revenue account will be service revenue. And then you could pretty much have any expense account that you're looking at here. Rent expense, salaries expense, utilities expense, advertising expense. The list could go on and on. You could have supplies expense, wages expense, property taxes expense. Pretty much any expense you can dream up, you could have that. Okay, let's look at rules for double entry accounting. And what I want to do here is kind of go through these and then show you how to work through some of these problems in another video by going through a comprehensive problem where we build each of the steps in the accounting cycle in that problem. Okay, so let's look at this. Here's the rules. Again, you can debit or credit any account. You just can't violate any of our debit or credit balance rules. Again, AWE, debit balances increase by debiting, decrease by crediting. And remember, CLR, increase by crediting and decrease by debiting. You must always have at least one account that is debited and one account that is credited in any journal entry. There's no exceptions to that. Plus, the total amount of all debits must always equal the total amount of all credits. And that must not be, neither of those two things have any exceptions to those rules. They must always be in compliance. You are able to make compound journal entries as long as you don't violate the rules above, meaning if I had 3 accounts that I debited and 1 account that I credited, that would be fine as long as the total amount of the debits equal the total amount of the credits. Technically, I could have 50 debits and 30 credits. As long as our amounts are the same, that would be an allowed journal entry. Here are 2 questions to ask yourself when doing journal entries. Really, has anything come into the business? And has anything left the business? At this stage of the course, those 2 questions should help you quite a bit get through the journal entries that we're looking for. Let's look at steps 3 and 4 of the accounting cycle, and then we'll be able to go do a problem on this. Step 3 is to post all journal entries from step 2 to the general ledger T accounts. And step 4 is to prepare a trial balance. We'll take a close look at all the first 4 steps in a problem in the next video.